Have you ever wondered how the ultra-wealthy seem to get richer even when they're in debt? It's a secret that might surprise you. Rich people don't just save money, they borrow it. But this isn't your everyday credit card debt. It's a powerful tool called financial leverage, and it can build fortunes. Or destroy them. Today, we're diving into the world of big money and big risks. We'll uncover how the wealthy use debt to their advantage, and why it sometimes backfires in spectacular ways. Get ready to see money in a whole new light. The power of leverage. Imagine you're playing with building blocks. You can stack them one by one, slowly building a tower. That's like saving money the old-fashioned way. But what if you had a lever that could lift 10 blocks at once? That's financial leverage. It's a way to use a little bit of your own money to control a lot more. Rich people love this trick because it can make them wealthy much faster than just saving. Here's how it works. Let's say you want to buy a $100,000 house. You could save up for years to buy it outright. Or, you could use $20,000 of your own money and borrow $80,000 from a bank. Now you control the whole house, even though you only paid for a small part of it. If the house goes up in value, you get all the profit, not just 20% of it. That's the magic of leverage. Why rich people love debt. You might think rich people would avoid debt. After all, isn't being debt-free good? Not always, and here's why rich folks see it differently. When rich people borrow, they're using someone else's cash to make themselves richer. It's like having a friend invest in your lemonade stand, but you keep most of the profits. In many countries, the interest paid on certain types of debt can be tax deductible. This means rich people can borrow money and get a tax break at the same time. As prices go up over time, the value of debt goes down. $1 million loan today might feel like much less in 20 years, but the asset bought with that loan could be worth much more. By borrowing, wealthy people can make big moves without touching their own money. They can keep their cash invested in other places that might make even more money. The risky business of big borrowing. Now, this all sounds great, right? But there's a catch. Using leverage is like driving a race car. When everything goes well, you can win big. But if you crash hard. Here are some of the dangers. Remember our house example. If the house value goes up, you win big. But if it goes down, you lose big too. You might end up owing more than the house is worth. Borrowing isn't free. Interest payments can eat into profits, especially if investments don't perform as well as hoped. When rich people borrow against their investments, they might face margin calls if those investments lose value. This means they have to put up more money or sell their investments at a bad time. For big-shot investors and companies, using too much leverage can make them look risky. This can scare away other investors or make it harder to borrow in the future. Real-world leverage gone wrong. Let's look at some times when leverage didn't work out so well. In 2021, a family office called 𝐟𝐸𝐫𝐠 Capital made headlines for all the wrong reasons. They used massive amounts of borrowed money to bet on stocks. When some of those bets went bad, they couldn't pay back the loans. This led to a fire sale of stocks worth billions of dollars, causing huge losses for banks and shaking up the stock market. Remember the 2008 financial crisis? Lehman Brothers, a huge investment bank, was right in the middle of it. They borrowed tons of money to invest in risky mortgages. When the housing market crashed, Lehman couldn't pay its debts. Their collapse sent shockwaves through the global economy and helped trigger a worldwide recession. Back in 1998, a hedge fund called Long-Term Capital Management, LTCM, thought they had it all figured out. They used complex math and huge amounts of borrowed money to make bets in the financial markets. For a while, they looked like geniuses. But when Russia defaulted on its debt, LTCM's bets went bad. They lost billions and almost caused a financial panic. The US government had to step in to prevent a meltdown. The good side of leverage. Now, it's not all doom and gloom. When used wisely, leverage can do amazing things. Elon Musk, the famous entrepreneur, used leverage to help build Tesla into a car-making giant. Tesla borrowed money and raised funds from investors to develop electric cars when many thought it was impossible. The gamble paid off, and Tesla became one of the most valuable car companies in the world. Many real estate tycoons have built their fortunes using borrowed money to buy properties. They use rent from tenants to pay off the loans, slowly building ownership of many buildings. Over time, as property values rise, they can become incredibly wealthy. Amazon, the e-commerce behemoth, used debt strategically to fuel its massive growth. They borrowed money to build warehouses, develop new technologies, and expand into new markets. This helped them grow much faster than if they had relied only on their cash. How regular people can use leverage. You might be thinking, this all sounds great for billionaires, but what about me? Well, you can use leverage too, but you need to be careful. Here are some ways regular folks might use financial leverage. When you get a mortgage to buy a house, you're using leverage. You control the whole house while only putting down a small percentage of its value. If home prices go up, you benefit from the increase in the entire home's value, not just your down payment. Many small business owners use loans to start or grow their companies. This can help them buy equipment, hire employees, or develop new products faster than if they only used their savings. Some investors use margin accounts to borrow money from their broker to buy more stocks. This can amplify gains, but it can also magnify losses, so it's very risky for beginners. Taking out student loans to get a degree that increases your earning power is a form of leverage. You're borrowing against your future earnings potential. The psychology of leverage. Using leverage isn't just about math and money. It's also about how we think and feel. Here's why it can be so tempting and dangerous. When things are going well, it's easy to think we're financial geniuses. This can lead to taking on too much debt, and thinking nothing can go wrong. Borrowing money can make us feel powerful and in control. But the truth is, the more we borrow, the more outside forces can affect us. For some people, using leverage is exciting. The potential for big wins can be addictive, leading to riskier and riskier bets. When you're using borrowed money, there's a lot of pressure to make it work. This can lead to poor decisions or trying to cover up losses. Lessons from the leverage masters. So, what can we learn from how rich people use leverage? Here are some key takeaways. Smart investors know how much debt they can handle. They don't push it to the max. The best leveragers always have a backup plan. They keep some cash or other safe assets in case things go wrong. Before using leverage, make sure you know all the ways it could go wrong. Don't just focus on the potential upside. Leverage works best when it's used to buy assets that can grow in value or produce income, not for personal spending. Don't put all your borrowed eggs in one basket. Spread the risk across different investments. The future of leverage. As we look ahead, leverage is likely to remain a powerful but controversial tool in the world of finance. Here are some trends to watch. After past financial crises, there have been calls for stricter rules on how much leverage banks and investment firms can use. This debate is likely to continue. With the rise of cryptocurrencies and decentralized finance, we're seeing new ways to use leverage that might be harder to regulate. There's growing pressure on investors to consider the environmental impact of their investments. This might affect how leverage is used in industries like oil and gas. Advanced computer models and artificial intelligence might help investors and regulators better understand and manage the risks of leverage. As we wrap up, it's worth asking, is it right for rich people to use so much leverage? Some say it's just smart business. Others argue it creates too much risk for the whole financial system. There's no easy answer, but it's a question worth thinking about. So there you have it, the powerful, risky world of financial leverage. It's a tool that can build empires or bring them crashing down. Whether you're a billionaire or just starting out, understanding leverage can help you make smarter financial decisions. What do you think? Is leverage a smart strategy or a dangerous game? Leave your thoughts in the comments below. And if you found this video helpful, don't forget to like, share, and subscribe for more insights into the world of money and power. Thanks for watching, and remember, in finance, As in life, with great power comes great responsibility.